Well, hello and welcome back to Principles of Accounting 2. I am your host, Dr. B. Welcome to the first day of the summer 2022 semester for Principles of Accounting 2. This is a 6-week course. For those of you who are so brave to hang out with me for 6 weeks during the summer, I appreciate you being here. Now, since this is a 6-week course, what does that mean? Well, you might be wondering, what does it mean? 6 weeks. Instead of being with me for 8 weeks or for 16 weeks, it's only six. So we got a short 6 weeks to get through all of the same content that you normally would see in an 8 week or 16-week course. So it's kind of like accelerated, right? What does it mean? Every week we have two chapters to get through. Every week for the next 6 weeks, we got two chapters to get through. Okay, because you're learning all the same stuff that you normally would in a regular speed course, if you will. And so I want you to take some time, look at through the classroom. Always to start here first. You could go through all this great stuff if you like, but the most important one on here, of course, is the syllabus. In the syllabus, I would like you to take a quick glance at the syllabus. You can download it or you can view it or whatever. Of course, at the top, you have my email address, my cell phone number, my office hours. Very, very important. Anytime you need to get a hold of me, these are the best methods. Of course, email's the fastest. That's just, it goes right to my phone, it goes right to there, so I just respond right away. Reading through, this is Principles 2, so it builds off of what you learned in Principles 1. So it's good that most of you had taken this course with me back in the spring. So you didn't have too much time away, so there was not too much of a gap. If you may have forgotten a few things, it's okay because it's the same textbook and you could always give yourself a little refresher and go back and go through some basic concepts if you need to. But just remember that this course builds off of what you already learned in Principles 1. So the difference between Principles 2 and Principles 1. In Principles of Accounting 1, we talked about how to develop, how to read and analyze the income statement, balance sheet, statement of cash flows, and the statement of retained earnings. Those were like the most basic concepts of understanding how accounting works. We learned about journal entries, we learned about inventory valuation, we learned about a lot of different concepts that help to build the body of knowledge. And now that we're here in Principles 2, we're going to take what we've already learned and look at it from a managerial perspective. We're going to talk about cost, making decisions for the company based on cost, various analysis. We'll talk about the concepts of break even and how to go beyond break even. We'll be talking about activity-based costing, budgeting, a lot of fun concepts. And as always, I'll do my best to walk through the course with you and apply various scenarios that I've been in. We'll use real world examples, all that fun stuff. The textbook, it's the same book, so please make sure that you have the same book. It is the Fundamental Accounting Principles through McGraw-Hill, 24th edition. If you have the 25th edition or the 23rd edition, it's fine. It's all the same stuff. The chapter number might be a little different if you have a different edition, but it's really the same book. It's just a continuation of the same book. And so let me bring you down to what you're probably all waiting for, and that is what's going on in this course. So Here's how it works. There's two discussion boards. One of them is worth 10 points. They're both worth 10 points each. That's a lot of points, Dr. B, for a discussion board. Yeah, it sure is. The first discussion board is actually due this Sunday night, and it's on Chapter 17, which is what we're about to discuss. And I want you to be aware that it's worth 10 points. Discussion boards cannot be done twice. So please make sure you follow the directions. I'm looking for full paragraphs, okay, citations, references, and make sure you respond to 2 or more of your classmates in the discussion. That's the Chapter 17 discussion. There's another one that's later on. I forget what chapter number it is. I think it's like chapter 24. It's more essay questions than it is discussion board, but it's also worth 10 points. So 2 discussion boards worth 10 points each, 20 points total. There are 4 homework assignments in this course. They're each worth 5 points apiece. Remember, 2 attempts for each homework assignment. There are 4 quizzes worth 5 points apiece. Remember, there are 2 attempts for each quiz. There's 1 midterm exam worth a total of 20 points. I know, it's heavy, right? It covers chapter 17 through 21. Believe it or not, that'll be at the end of week 3. And then at the end of week 6, you'll have the final exam, which will cover chapters 22 through 26, also worth 20 points. All exams, quizzes, homework assignments are open book, open note. Okay, so you don't have to stress too much about that. But just be aware that a lot of those questions you might have seen before on the homework assignment or quiz. Hint, hint. So just something to think about when you get to the midterm exam and the final. How are the points broken out? 90 through 100 is an A, 80 to 89 is a B, 70 to 79 is a C. You can't get anything below that, otherwise you fail, right? You have to have a C or higher to pass this course. Each week we will cover 2 chapters. Right now we're about to jump into chapter 17. And right after that we'll talk about chapter 18. Next week we'll do 19 and 20. The week after, 21, and you'll have the midterm exam. Week 4 is 22 and 23. Week 5 is 24 and 25. Week 6 is chapter 26 and the final. Any questions? Makes sense, right? Is it logical? Does it, you all good with this? Yeah? Okay. All right, I trust y'all. Still listening, right? You didn't just put me on mute and walk away, right? Okay.
We're here, Professor.
All right, all right. I'm just checking the temperature. Okay, thank you so much. All right, so the rest of that stuff you can read on your own time, but I just want you to know that it's there and for you to understand how the course is set up. In the classroom, just as before, you have your textbook folder to access your textbook, office hours link to set up office hours with me, the WebEx link, that's how you got here. And in module 1, we are currently in week 1. Some of you have already done your introductions. Thank you so much. It's not required, but I always encourage it. You know how it is. I like to try to build community around you all. Your first homework assignment is about to be talked about, the chapter 17 discussion board. Please make sure full paragraphs, references, citations, and respond to more of your classmates. As long as you follow directions, I promise you, you'll do well. The PowerPoint presentation is about what we're about to go over. That's also found here. And then after our conversation on Chapter 17 analysis, financial statement analysis, we'll jump into Chapter 18, which is about managerial accounting, which is the foundation of this course. So let's go ahead and jump into our conversation on financial statement analysis. This is Chapter 17. The reason why we have financial statement analysis, at least I have financial statement analysis as being the first chapter for this course, is because we need to bridge what we learned in Principles of Accounting 1 to Principles of Accounting 2. The best way I can do that for you is for us to analyze financial statements, to kind of recall what is income statement, balance sheet, statement of cash flow, statement of retained earnings, and how do we analyze the information from those financial statements. And that's what this chapter is all about. It's kind of like a bridge between Principles 1 and Principles 2. We build on the information that we learned back in Principles of Accounting 1. And so I'm going to walk you through a couple of methods of analyzing the financial statements using a couple of different methods. Primarily, we'll be talking about the horizontal analysis method, the vertical analysis method, and of course, ratios. Who doesn't love ratios? I know you all love ratios, especially if you like math. But for those of you who don't like math, you might not like ratios all that much. The good news here is that as long as you know the formula, it's just a matter of plugging in the numbers, right? So we'll try to make it easy for everyone to understand. So let's talk about why we analyze financial statements and who's doing and who uses that kind of information. As you recall from Principles of Accounting 1, there are two types of users of information. We have internal users and external users. Internal users are the people inside the company. These are managers, employees, officers, auditors, the people that work for the company. Those are internal users of information. They use the financial statements to make decisions. They use the financial statements to budget. They use it to make decisions. They use it to understand the financial performance of the company inside the company. Internal users. The other kind of users, as you recall from Principles of Accounting 1, are external users. These would be people like the government. They want to know what's going on with your company so they know how to get proper taxation, right? Shareholders, they want to know how well the company is doing because they need to make this investment decisions, whether to buy the company's stock or not. Banks, lenders, they want to know how well the company's doing to make lending decisions. And of course, your vendors, suppliers, they want to know how well the company's doing in order to possibly lend a line of credit to the company or to know when they'll get paid back, right? So those are your external users. Both types of users look at the company's overall financial health and performance based off of past and current performance. They look at the current financial position, how well is the company doing currently, and what does future performance and risk for the company look like? Is there a storm on the horizon for that company? Maybe a new competitor came out and there's going to be more competition. That's a risk. Or is the company going to continue outperforming previous years? They're going to keep selling and selling more and more. That's future performance. So these are the kinds of information that internal and external users use in order to make decisions about the company. Okay. When we look at the financial performance of a company based off of the income statement, balance sheet, statement of cash flows, and the statement of retained earnings, I need to know uh, these four factors. Okay, we call these the building blocks. Liquidity and efficiency. Can anyone tell me, class? Can anyone tell me? What do you think liquidity means? What does it mean to be liquid? Any thoughts? What does it mean to be liquid? Shanae. Shanae, what does it mean to be liquid?
I guess to be transparent.
Yeah, you're on the right track. You're on the right track. Think about, Shanae, let's think about this for a second. So, what's on the balance sheet? Do you remember? What's on the balance sheet? What are like the three primary categories on the balance sheet? Three primary categories on the balance sheet. What are they? Who can tell me? Shanae. You there?
Assets,
Assets, that's one. Give the accounting equation.
liabilities,
Liabilities, that's two. And
I'm gonna say
starts with
equity.
equity. You nailed it. Yep.
Okay.
Assets, liabilities, and equity are on the balance sheet. Liquidity is, does the company have the ability to convert its assets into cash? Right? Assets into cash. Does the company have the ability to sell its inventory? Right? That's liquidity. Right? That's if the company has the ability to sell its assets, that means it's liquid. Okay, liquid. Think of cash. So when you hear liquid, think cash. Because remember, cash can be used for a lot of different things. It can be used to purchase inventory. It can be used to pay bills. It could be used to invest back in the company and purchase other assets. There's a lot of things we can do with cash. That's liquid. That's liquid cash. And efficiency, how easily can I do that? Okay, who can tell me? What do you think it means to be solvent? What does solvent mean? What is solvency? What does it mean to be solvent? Any ideas? Anything at all? Solvent. Remember, no wrong answers. Solvent. What does it mean to be solvent? Giovanni. What does it mean to be solvent? Any thought? It's okay if you don't know. All right.
To not have any to
Go ahead.
to not to what is it? It's like when you don't have debt, when you are like not self-sufficient. I guess self-sufficient
Yes.
is the word.
Yeah.
I'm not using the right terminology, but it's
You're
when
right.
you don't owe debt.
You got it. You got it.
Okay.
Yeah, Shanae, you're spot on. Okay, so solvency means the company has the ability to use its assets to cover or pay for all of its debts. Okay, so the company has enough assets to pay for all of its liabilities. That's solvent. Okay, there's short-term solvency and long-term solvency. But technically, it means, just as you said, Shanae, the company has the ability to pay all of its debt. It doesn't have debt. It doesn't. That's solvent. Exactly. The technical definition is the company has the ability to go out of business by paying all of its debt. That's solvent. Okay. Uh, yeah, solvency is a great thing. I always invest in companies that are solvent. That means they have enough assets to cover all of their debt in the event that they need to go out of business. That's the technical definition. Well done. Profitability, that's Relatively self-explanatory. It's a company's ability to generate a profit based off of its sales, right? That's profitability. Market prospects. This has to do with like things like stock price, equity investments. It also has to do with the company's position in the marketplace. It also has a company's ability to market its products. So market prospects covers quite a few things. But these are the building blocks of our financial statements when it comes to analyzing our financial statements. As I mentioned before, as you know, there are four primary financial statements. There's the income statement, the balance sheet, the statement of cash flow, and the statement of stockholders' equity, or retained earnings as we know it. Uh, Income statement, balance sheet, statement of retained earnings, statement of cash flows. Those are the four primary financial statements. Each financial statement has notes. These notes indicate changes within the information from year to year. These notes also have, they talk about things like prospects of the company's performance and, reasons for increases or decreases. They're just notes, okay? They're just handwritten notes about the performance of the company. The notes tell a story. And when I'm analyzing a company's financial performance, I usually look to the notes when I see big changes because it tends to tell me exactly what happened. But this is all the information we need to gather in order to analyze financial statements. Uh, okay, so I in business, it's important to know where you stand among your competitors. It's important to know where you stand within your industry. We do this. We know where we stand in our industry and among our competitors because of this thing called the standards for comparison. I can compare my company's performance to any other company in my industry. Okay? How do I do that? Well, I use the methods for analyzing my financial statements and I compare that analysis to the performance of my competitors. In other words, I can look at using horizontal analysis the changes in the percentages, and I can compare that to the changes of percentages among my competitors. It's called benchmarking. We're benchmarking our performance to our competitors' performance. We can do the same for the industry and across subsidiaries within our own company. So these are what we call the standards for comparing the financial performance from one company to another. How do we do it? One of them I just talked about. It's called the horizontal analysis. And these are the three primary tools that we use in analyzing our financial statements. The horizontal analysis, which is the first one, compares the financial condition from year to year, or month to month, or quarter to quarter. Usually year to year is how often I do it personally. And so the reason for that is I want to know if my sales went up or down based off of last year's numbers. I want to know if my expenses went up or down based off of last year's number. I want to know if my balances on my balance sheet went up or down based off of last year's numbers. To do that, I use the horizontal analysis approach. And with that, I'm looking at the change in the dollar amount and the change in the percentage from year to year. I'll show you what it looks like, so stay tuned for that. But that's what horizontal analysis is. And the reason why it's important for you to know how it works is because you might be in a position someday where your boss comes to ask you, or an investor comes and asks you, Well, has the company's financial position uh, for this particular category improved or not? How do you know? Well, you can demonstrate that through horizontal analysis. The second tool we use is called a vertical analysis. This comes into importance when I'm looking at what I call common sized financial statements. Let's say we have two different companies. Let's say we have Marriott and we have Choice Hotels. All right, two very different hotel companies. Marriott owns most of their hotels. Choice Hotels franchises most of their hotels. Okay. Marriott reports their amounts in thousands on the financial statements, and Choice Hotels reports their amounts in tens of thousands on the financial statements. Okay, so they visually look different. Uh, and so one way to compare two different companies that look visually different on the financial statements is to perform what we call a vertical analysis. And what this does is it applies a percentage using a base amount for the financial statements for comparison reasons. Uh, and so I'll show you what that looks like here in the coming slides. But that's a fun tool to use. And last but not least, we use ratios. We've talked a lot about ratios even back in Principles of Accounting 1. I know most of you remember that because you didn't like me for it, and that's okay. But I want you to know that ratios come back in Principles of Accounting 2. We use a lot of ratios, in fact. Ratios are helpful because I can look at a ratio, do a real quick computation using a ratio, and it'll tell me exactly if the company has the ability to pay its current debt or not using the current ratio. Or I can look at the company's ability to earn a profit or to be solvent, right? There's so many different ratios that are really helpful and really quick and easy to compute. So that's why it's another important tool when analyzing financial statements. So let's take a look at that horizontal analysis first, the one I told you about, where we look at data from year to year. Now, when I'm looking at data from year to year, the financial performance from year to year, I do two things. I compute the dollar change, and I also compute the percentage change. The dollar change is pretty easy. We take the current year and we subtract it from the prior year. Current year to the prior year. Uh, the way to think about it is new minus old. New minus old. That's like a real cheap shot at remembering this trick. Dollar change, the current dollar amount minus the old dollar amount, the base year. We're analyzing the current performance. So we're looking at the current year minus the prior year, the base amount. That's how we find dollar change. It helps us to understand the change across time. Did our dollar amount go up? Did it go down? And what caused the change, right? And we use this for comparison reasons. And as I had said, I also take the percent change into consideration. Percent change tells me by what percentage did the amount change from year to year. And the way to do this is we take the current dollar amount minus the previous year dollar amount divided by the previous year dollar amount. So the current year dollar amount minus the previous year dollar amount divided by the previous year dollar amount, and I multiply that by 100, and it gives me the percentage, the percent change. So new minus old divided by old. It's just a quick trick. New, current, minus old last year divided by old last year times 100. That gives you the percent change. Very, very common formula. You probably saw this in statistics, maybe. If you haven't taken that course already, you probably will see it there. Or maybe in like personal finance or something like that. You may have seen this before, but this is like the most common way of calculating the percent change. And there's a good chance you'll use this in your career at some point. So let's take a look at what it looks like visually on a balance sheet. Okay. Now, as Shanae had told us, we have assets, liabilities, and equity on our balance sheet. And so we can compute the dollar change and the percent change by looking at the current year and the previous year. So the dollar change, remember, it's the current year minus the previous year. Current year minus the previous year gives us the dollar change. The percent change, we take the current year minus the prior year divided by the prior year to get the percent change. This information is really helpful because it shows me in all of my assets, liabilities, and equity where the changes have occurred and how much they change by. You know, in doing this, as a manager, I can make decisions and I can analyze this information. Look, for example, if you look at inventories, inventories in the current year is $4,855. The previous year was $2,132. That is a total dollar change increase by $2,723. That's a percent change of 127.7%. That's really big, right? So I might say, okay, now why did that happen? You know, because that number stands out to me. It says, wow, this is a really big change. Something big must have happened. Maybe I went on a purchasing spree and got a whole lot more inventory on hand that I plan to sell in the future. Okay, that makes sense to me. But somebody who's doing these computations, it causes you to think about what caused such a big percent change. So that's what makes it fun, right? That's what makes these types of analysis entertaining because we can do a deep dive and say, man, there's got to be a reason for this, and it gets us thinking as managers. It says, hey, why did that happen? So then you do a deep dive and take a look. But it's just fun, you know. And this is the balance sheet. Of course, I could do the same thing with the income statement. Uh, and that's what this looks like, the income statement. Again, dollar change, current year minus the previous year. The percent change, current year minus the previous year divided by the previous year to get the percent change. And we can also see here a big number that sticks out to us, 103.6%. That's really big. That came from other income. You know how I feel about the word other. But other income, that could be something, maybe the company sold an asset that it had sitting there. That could be other income, right? There's a reason for it. And so these types of things get us to think about what had to happen. Does it make sense, this structure? Everyone understands how to do dollar change and percent change? Those are important concepts, yeah? Hey, all right, let's keep rolling. All of that is important. You know, the horizontal analysis is important because we need to see the trends. All right. When you look at multiple years, let's say you look at 3 years, okay, instead of just two, you look at 3 years, and the 3 years, we need to kind of understand, well, what is the trend here? Are our sales increasing? Are they decreasing? What's going on with our expenses? we can compute what we call a trend percent. And it tells us the change across multiple years. We take the current year divided by the previous year times 100. That gives me a trend percentage. Tells me the direction from a trend perspective. I can do that for multiple years. We can go back as far back as you want to go. In this example, we go back for 4 years. And looking at the 4 years, the current year divided by the previous year times 100 gives me the percent trend change. And so that kind of tells me the overall trends of what's been happening, right? So, and the base year, looking at year 4, and then going across to the current year, gives us the trend. The trend. We can graph those trends out graphically in Excel, and it could tell us the trends. That's how we get the line graphs, the trend graphs. So that's the horizontal analysis. Now let's talk about the vertical analysis. Earlier I had mentioned that the vertical analysis is mostly used for comparing two different companies side by side, especially for companies that have different measurements for their financial statements. Like, for example, when you look at um, Marriott hotels versus Choice hotels, Marriott's in thousands and Choice hotels is in tens of thousands when you look at their financial statements. And so, because of the reporting structure reading differently, what we typically do is we apply what's called the common sized financial statements. And what that does is it puts both companies into a common size. In other words, I can analyze the performance of both companies using a common size, right? It's kind of like the percentage I'm using to make them on even playing field, so to speak. And so I do this for the income statement and balance sheet. Now here's how it works. The percentages, I take the amount that I'm looking at and I divide that by what we call the base amount and multiply that by 100. The base amount depends on the financial statement. The base amount depends on the financial statement. Okay? The base amount depends on the financial statement. On the balance sheet, the base amount is always going to be total assets. Total assets is the base amount on the balance sheet. And so basically the way it works is I take whatever amount on a line item on the balance sheet and I divide that by total assets. So if, for example, I would take cash divided by total assets, inventory divided by total assets, um, accounts receivable divided by total assets, and so forth and so on. I do it for every item on the balance sheet. And what that does is it gives me the common size percentage for everything on the balance sheet. And on the income statement, as you know, on the income statement, we have our revenues, we have sales, and we have all of our expenses. And then we have net income and taxes and all that stuff, fun stuff. So on our income statement, we use the base amount is total revenue. Okay, total revenue. Income statement is the base amount. So I could go cost of goods sold divided by total revenue. I could go uh, rent expense divided by total revenue. I could do utilities expense divided by total revenue. Every item on the income statement, I do that. And it gives me the percentage, common size percentage of everything on the income statement. So let me show you what it looks like on the balance sheet and then the income statement. So we can see, for example, I take the current year cash amount and I divide that by the current year total assets. Okay. and the percentage is 5.4%. I do that for every single item and every single year. It's very easy to do this in Excel if you have the information in Excel. It's a matter of plugging it in and filling it out. Very simple. It's all formula driven, you know. So anyway, we can see the percentages for each year, and we can actually do a trend analysis doing this. And the way that you know you've done this correctly, here's the trick. Okay, the trick to know if you've done this correctly, you know that assets equals liabilities plus equity. We can see the percentages 100% total assets, because remember, that's our base. We know that assets equals liabilities plus equity. That's the accounting equation. So liabilities plus equity, which is at the bottom of your balance sheet, is also 100%. So that's when you know you've done it correctly. And we can see the income statement, same concepts. We take so total revenue, net sales, same thing. It's 100%. That's our base. So base divided by base, 100%. When you do the same thing, cost of goods sold divided by net sales is 61.5%. Gross margin divided by sales, 38.5%, so forth and so on. How do you know you've done this correct? If you add up the percentages from cost of goods sold, cost of sales, all the way down to your net income, all of those equal 100 when you add them all together. Just a little trick. But we can see the reason why we do this is to better understand the trends, and we can compare the company's performance to other companies based off of this information. And of course, we could always make it nice and graphical. We can present the information in meaningful ways for people who don't want to read the financial statements. Make it nice and easy for them to visualize. We call this data visualization, which is very, very common, especially for those of you who are thinking about getting into, the finance industry or the accounting industry. You definitely want to know how data visualization works, because this is how you would present information to stakeholders. And the last method that we're going to talk about today on analyzing financial statements is, of course, through ratios. We talked about these four building blocks of analysis earlier: liquidity, solvency, profitability, and market prospects, because there are a lot of different ratios within each of these areas that we can compute to analyze the financial performance and health of the company. Within liquidity, we're looking at the company's ability to turn its assets into cash, right? That's the whole idea behind the word liquidity. How quickly can the company turn its assets into cash? We can compute things like the current ratio, asset test, accounts receivable turnover, total asset turnover, days in sales, days uncollected, and inventory turnover. Ooh, that's a lot of stuff. That's so many ratios, Dr. B. You're killing me with these things. I know, I'm sorry. But they all tell their own story. The reason why so many different ratios exist is because oftentimes we're looking at different parts of information individually in order for us as managers to make decisions. The current ratio tells us the company's ability to pay its current liabilities, liquidity, right? And so, using cash to pay your current bills. That's what current ratio tells us. Uh, and so I'll show you what each one looks like. We also look at this one called working capital. Working capital is really important for every company to have. If it has positive working capital, it's doing well. Working capital gives us what's left over after the company pays its current bills. What's left over after the company pays its current bills. That's called working capital. I can invest that capital back into the business. I can purchase more uh, inventory with that working capital. I can build out a factory. I can do a lot of things with working capital. It's what's left over after I pay my current bills. The better working capital, the better the company's doing. Right? The higher working capital, the better the company's doing. So we take current assets minus current liabilities to find out how much working capital the company has. It's a nice, easy ratio. The current ratio, like I was telling you earlier, tells the company's ability to pay its current debts. We take current assets divided by current liabilities. Tells us the company's ability to pay its current debt. Of course, the higher the ratio, in this case, the better. The asset test ratio is similar to the current ratio, but the difference here is that it excludes inventory and prepaid expenses. So asset test ratio is cash plus short-term investments plus accounts receivable divided by current liabilities. We call this the uh, asset test ratio. Accounts receivable turnover tells me how quickly I can get my money from my customers. That's the short answer to it anyway. We take our net sales divided by average accounts receivable. Now you might be asking, what in the heck is average accounts receivable? Remember, when you hear the word average, the easiest way to figure out what the average is you take the beginning balance plus the ending balance and divide by 2. Beginning balance plus end balance divided by 2 gives you the average. That gives you the average. Beginning balance plus the ending balance divided by 2 will give you the average. That's the same for pretty much any time you see the word average. Okay. How quickly I can convert that receivable into cash. How quick am I going to get paid for my customers? Inventory turnover. How quickly can I sell my inventory? How many days it take me to sell my inventory? We find this by taking the cost of goods sold divided by average inventory. Remember, average, that word again. Beginning balance plus ending balance divided by 2 to find the average. Average inventory. Day sales uncollected. Oh my goodness, let me tell you, I don't like when I can't collect from my customers. Drives me crazy. I gotta get paid. The company needs money. I gotta invest the money. How do I do this? How do I do this? Day sales uncollected tells me how quickly I'm collecting my accounts receivable. How many days? How many days on average I'm collecting my receivables? We take accounts receivable divided by sales times 365 days. Tells me how quickly I'm collecting accounts receivable. That's a good measure because what that tells us is I can project how often I'm going to get cash coming into the business in order for me to stay afloat. Right? Day sales and inventory. This tells me how long my inventory is sitting on the shelves. Okay? For those of you in retail, this is a really good measurement because so oftentimes you'll go to work and you'll be walking through the retail store. You'll say, "Man, I wonder how long that's been sitting there for." Day sales and inventory, a very quick and easy way to figure it out. We take the ending inventory divided by the cost of goods sold, multiply that by 365 days. Tells you how, on average, how long that inventory's been sitting on those shelves for. If you compute this and you show the store manager this, I'd be quite impressed. Just saying, I'd be impressed if somebody showed me this. Total asset turnover. Uh, the company's ability to generate sales. That's all what this tells me. What is the company's ability to generate sales? It's a fun, quick, and easy ratio. We take sales divided by average total assets. There's that word again, average. Beginning balance plus ending balance divided by 2. That's how you find the average. Okay, the next batch of ratios, solvency. Now we talked about this, right? This is a company's ability to pay all of its debt and go out of business. That's solvency. Company's ability to pay all of its debt. That's why you see debt in all these ratios. Debt ratio, equity ratio, debt to equity ratio, and times interest earned. Debt ratio. This one you probably, if you own a home, I guarantee the bank ran this ratio on you. Okay. If you own a home, the bank ran this ratio on you. If you own a car, the bank ran this ratio on you. It's called the debt ratio. Well, debt and equity ratio. The way it works, uh, the debt ratio, we take the current year total liabilities divided by total liability and equity. Gives me the debt ratio percentage, 64.3% in this example. So total liabilities divided by total liabilities plus equity gives me the debt ratio. How do I find the equity ratio? It's the opposite. Okay, the equity is going to be current year equity, total equity, divided by total liabilities plus equity. Gives me equity ratio. If you add the two together, it should equal 100%. Why now? Uh, it's important in your personal life for cars and for houses. It's important in business life to understand how the company is being leveraged. What I mean by that is when you start a company, there are two ways to raise money. One is through equity and one is through debt. Okay. Debt financing is taking out the loans from the bank. That's debt financing. Okay. Equity financing is getting money in from investors. It could be the people starting the company. It could be you're selling stock in the company or ownership in the company. That's equity financing. Debt financing, you're getting the money in from the bank through loans. Equity financing, you're getting the money in from your stockholders and founders, investors, etc. These ratios tell me how leveraged the company is. And that's why it's important to understand the balance between equity and liabilities. And of course, the debt to equity ratio, we take total liabilities divided by total equity. Uh, Again, this kind of implies the company's ability to obtain more debt versus equity. It's this one's used by a lot of banks to they compute this in order to figure out how much more loans they can take on. Whether that's good or bad, I don't know. I'm kind of indifferent on it, but it's one of the ratios that they use. Last one's times interest earned. This one tells me the company's ability to pay interest on its debt or interest to investors. We take the income before interest and taxes and divide that by interest expense. Both of those line items, as you know, hopefully you know, are both found on the income statement. Profitability is the third building block of analyzing financial statements. In this one, we look at profit, the profit margin. You all remember the profit margin from Principles of Accounting 1. That's when we talked about the difference between the sales price and the cost of manufacturing the product. We also look at the return on assets and the return on common stockholder equity. Profit margin. We take the net income, which is found at the bottom of the income statement, divided by net sales, which is net revenue, found at the top of the income statement, toward the top. And it tells me the company's ability to generate a net income each year. Right? It's got to earn the profit. Return on total assets. How well is the company using its assets to generate revenue? That's what this one tells us. You take the net income at the bottom of the income statement, divided by your average total assets. Remember, average total assets is beginning balance total assets plus ending balance total assets divided by 2. Return on stockholders' equity tells me the company's ability to earn income for stockholders. Simple, straightforward. We're going to be able to pay our investors. That's what this tells us. Net income minus the preferred dividends divided by the average common stockholder equity. There's that word again, average. Beginning balance plus ending balance divided by 2. The last building block is called the market prospectus. This has to do with things like the stock price, the company's ability to generate additional revenue based off of stock issuance, things like that. Market, think market. Market expectations of future growth. We take the market price per common share divided by earnings per share. Earnings per share, you're going to find that on, it's usually posted at the bottom of the income statement, earnings per share. Market price per share, you'll find that typically on the balance sheet under equity. Dividend yield, this we're looking at for performance based off of different companies and a company's ability to pay a dividend. We take the annual cash dividends per share divided by the market price per share. Again, it's all based off of stock. Now, my friends, this slide right here, slide 46, these are all the ratios we just talked about on one single slide, okay? So those of you taking notes, this is the slide you want when it comes to that midterm exam. I'm just throwing a hint out there for those of you paying attention. So, slide 46, when it comes to midterm exam, this one's a good one to look at. Just throwing it out there. Instead of digging through all those other ones. This one's all right there on one slide. Okay. Now that we know how to analyze financial statements using things like horizontal analysis, vertical analysis, and ratios, we can also report that information and analyze the reports looking at things like notes. It's important for companies to maintain a stable net income. Call it sustainability. Sustainable net income. Sustainable income. Sustainable income tells us a company's ability to stay in business, to keep earning income, right? And we can figure out if a company has sustainable income by looking at things like changes in accounting principles, earnings per share changes, discounted segments, discounted products, or the continuing of operations. Sustainable. And we can analyze the income statement based off of that kind of information. That's kind of what it shows. Any comments, questions, or concerns about how to analyze financial statements? I hope this was kind of like refreshing for all of you. Any questions so far? Are we doing all right? Still with me? I know these night classes. Let me tell you, you guys still with me? Are you eating dinner? What's going on here? Who's out there? Who's out there? You there? Am I talking to an empty room? Okay, thank you, Giovanni. Okay. Uh, Now remember, chapter 17. You have a homework assignment that you owe me by Sunday night. That is the chapter 17 discussion. When you open this up in the classroom under week 1, here's your prompt. Discuss the differences between vertical analysis and horizontal analysis. You can use outside resources and make sure you have citations and references in your discussion post. Full paragraph, please, please, full paragraphs, and respond to 2 or more of your classmates also using full paragraphs. And that's how you'll earn full credit for this discussion post. If you want to see the rubric is also here. And it shows you exactly what you need to do in order to earn top marks. It has to be on time. It has to be full paragraphs. You have to respond to 2 or more of your classmates. And it should be very well written. Don't just write, don't hand jam it in there. Use proper grammar and spelling and punctuation, all that good stuff. Any questions on all that? Okay. Now stand by. I'm going to stop this recording, and then we'll probably take a short break, and then we'll start the next one. Hold on just 1 second, okay?